Hello, everyone. Nick Ryder here with another edition of Kathmere's Chart of the Month. We're now more than a year from the bear market low of last October when the S&P 500 bottomed after dropping more than 25% from its all-time high. With that, I thought it'd be interesting to take a step back to survey the landscape and assess how markets have performed since then. On the slide here, I present the performance of indexes covering various segments of the U.S. equity market over the last year and change. Following the market surge this spring and into the early part of the summer, the S&P 500 broke through the fabled 20% gain threshold that is commonly used to demarcate the start of a new bull market. By the end of July, the S&P was up more than 30% from last year's lows. Thus, in the eyes of many market watchers, a new bull market was in full swing. That said, something that struck me and many of our clients and other investors that I regularly speak with is that this bull market has all along felt quite different from a typical one, or as one investor put it, it feels weird. And there's absolutely a reason for that. Put simply, markets aren't behaving as they usually do at the start of a typical bull market. Typically, what you see during the early stages of a bull market, such as those following the market lows in 1990, 2002, 2009, 2020, is that just about everything goes up, and nearly everything goes up a lot. In addition, during the early stages of a bull market, the market is usually led by the most economically sensitive stocks and sectors of the market, such as small and microcap stocks and banks. This time, however, the usual heroes of the early stages of a bull market have taken a back seat. Specifically, on the chart, we see that the equal-weighted version of the S&P 500, a good proxy for the performance of the average stock, is up less than 8% and is trailing the overall market by a double-digit margin. Meanwhile, small and microcap companies aren't up much or even down. We see this with the Russell 2000 small cap index and the Russell microcap index, which tracks the smallest 1,500 or so stocks in the market. Banks, too, are in negative territory over the last year. Conversely, as we've covered in various other forums, the current bull market has largely been driven by the outsized outperformance of a number of mega cap tech titans such as Apple, Microsoft, Amazon, Nvidia, Facebook, and Google. This is clearly demonstrated by the outperformance of the S&P 100 and NASDAQ 100 indexes, which are heavily weighted towards those names. Clearly, the present bull market isn't like ones from the recent past and is indeed weird by historical standards. That said, not much about the last few years has been like the recent past, as it's impossible for me to count the times I've heard or read the word unprecedented when referring to the markets and the economy over the last few years. And importantly, for investors looking forward, it's absolutely critical to keep in mind that just because the present isn't like the past, it doesn't mean the present bull market won't last. However, the fact that the past year doesn't fit the standard pattern for a new bull market ought to give the raging bulls in the market pause for thought. That's all for this month. Thanks for tuning in, and we'll see you next month.